Hey, everybody, welcome to the latest episode of Legal Bites, the official podcast of Cummings and Cummings Law, where our primary focus is on assisting businesses and their principals redomesticate out of volatile legal and tax environments to predictable pro entrepreneurship, pro growth jurisdictions like Florida and Texas. Today, I am reviewing a recent report by Janelle Fritz for the Tax Foundation entitled Movers and Shakers in the 2026 State Tax Competitiveness Index. But before we get to that, a brief introduction. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, together with a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. And just in case you're wondering, no, I'm not AI. I am a real person, although sometimes people ask me that, which I find amusing. Anyway, on to business. The Tax Foundation, according to this report, has published a state tax competitiveness index every year for the past several years. It does not directly measure how much tax states collect. Rather, it measures how well states structure their tax systems, hence the word competitiveness. It is a roadmap that tells you which states are making it easier to do business and which states are creating new roadblocks and speed bumps. The Tax Foundation has published this study since 2003, and the 2026 edition reveals a divergence that every business owner in America should understand. 5 states, according to this report, saw the largest improvements in their ranking over the last 6 years. Tennessee jumped from 38th to number 8. Iowa jumped from 43rd to 17th. Georgia jumped from 28th to position number 18. Louisiana jumped from 40th to 31st. Arkansas jumped from 41st to 34th. Those are not small incremental moves. Tennessee gained 30 positions. Iowa gained 26. Those states did not just stumble into competitiveness, they engineered it through deliberate structural tax reform. Tennessee reduced its corporate tax rates, improved its treatment of business expensing, and eliminated its tax on individual interest and dividend income. It is now one of 8 jurisdictions with no individual income tax at all. Iowa repealed its alternative minimum tax, cutting its top individual rate from 8.53% to 3.8%, and collapsed 9 brackets into a flat tax, although they still have a tax, unlike Florida and Texas. Georgia converted its graduated individual income tax into a flat 5.19% tax and tied its corporate rate to match, which is an improvement, but still not a match for the Sunshine and Lone Star states. But I digress. I'll try to stay focused. Louisiana cut its individual rate from 6% to 3% and consolidated 5 corporate income tax brackets into one. Arkansas cut its corporate rate from 6.5% to 4.3% and its individual rate from 6.9% to 3.9%. Those are all improvements, to be sure. Now look at the other side. 5 states fell the furthest. Oregon dropped from position number 8 to number 35. Washington State dropped from 33rd to 45th. Colorado dropped from 22nd to 33rd. New Mexico dropped from 20th to 28th. Massachusetts fell from 36th place to 43rd. Big moves here. Oregon adopted a modified gross receipts tax on top of its existing corporate income tax. Washington, which previously had no income tax at all, is poised to impose a 9.9% capital gains tax on individuals. The Commonwealth of Massachusetts converted its flat income tax into a progressive scale by adding a 9% top rate on income over $1 million and enacted a new payroll tax on top of it. Colorado did not make any single catastrophic change, but rather failed to address existing inefficiencies in its code, while every competitor was cutting rates around it. The Tax Foundation describes Colorado as a cautionary tale of resting on laurels at a time when states are competing for new business. That characterization should concern every business owner in a state that appears on the losing side of this index. Your state does not need to raise taxes to become less competitive. It just has to stand still. And this is not an academic or theoretical exercise. Capital is mobile. People are mobile. Businesses are mobile. The Tax Foundation data quantifies what the Federal Internal Revenue Service migration data, the Illinois Policy Institute, and my recent report on information from the Boston Globe have all confirmed from different angles. Businesses and individuals are leaving high tax, high regulatory states at an accelerating rate, and they are moving to states with no personal income tax, no traditional corporate income tax, and a predictable regulatory environment that favors business formation and growth. Florida and Texas are the two largest no income tax states in the country. They sit at the top of almost every inbound migration list, and I have seen this firsthand in my law practice. And the mechanism for moving your existing business to one of those states is called redomestication. Redomestication is the legal process of transferring the so-called home state of an existing company from one state to another. You maintain your existing federal employer identification number. You maintain your existing contracts. You keep your bank accounts. You keep your credit history. And in almost every case, you keep your business name. The company that exists after the redomestication is the same legal entity that existed before when the process is handled correctly. Nothing changes except the state where the company is legally domiciled. It is a non-taxable reorganization under the Federal Internal Revenue Code when performed by a competent attorney. Redomestication, when coupled with a change of personal residency and a reduction or cessation of business activity in your prior state, can be a highly effective way to reduce or even eliminate tax nexus in your former jurisdiction. For owners of pass-through entities like most LLCs, subchapter S corporations, and partnerships where business income flows through to personal tax returns, the state-level savings can be enormous. If you are a business owner in Oregon paying the new gross receipts tax on top of income tax, or in Washington state paying almost 10% on capital gains that were previously untaxed, or in Mass paying 9% on your income over $1 million, the annual cost of remaining domiciled in your current jurisdiction is not abstract. It is a concrete line item on your tax return that stands to grow every year. Now, let me briefly address three so-called alternatives to redomestication and why all three are usually inferior. Foreign entity registration, also referred to as foreign qualification, keeps your company domiciled in your current state. You register in the new state, but you remain subject to taxes, filings, compliance requirements, and annual reporting in your former jurisdiction. You now stand to manage two distinct compliance tracks, not one. You save nothing on the tax side in most cases. You just doubled the administrative burden while remaining fully exposed to those liabilities that made you want to vacate. Now, old school merger or traditional merger still is sometimes a viable option, but in most cases it has been deprecated. Merger requires forming a new entity in the destination state and merging the old entity into it. Emphasis on the words new and old. Those matter. The old company ceases to exist. You will likely need a new federal employer identification number, and you very well may trigger a taxable event, especially if you try to practice law on yourself. You will likely need to retitle assets, novate contracts, and open new bank accounts. And legal fees for a simple merger can reach $10,000 to $20,000 or more. And if a single consent is missed or an assignment clause breaks, you have transmuted what should have been a simple exercise into a months or years, in some cases, years long business disruption. Now, option three, I put option in air quotes because it's really not an option. Dissolution, sometimes confusingly referred to as termination, kills the company. It's the death penalty. There's nothing left to move. You lose your liability protection. You lose your contracts. You lose your credit history. If lawsuits surface after dissolution, and that happens all the time, believe it or not, do your own homework, but really it does. Those claims will land on you personally, your personal bank account, your personal residence, your personal retirement accounts in many cases, because the so-called corporate veil, which also applies to LLCs, no longer exists unless you are truly going out of business and shutting your doors like Toys R Us. Dissolution is not a relocation strategy. Actually, Toys R Us might be a bad example because now they're back on an e-commerce platform, but I digress. Anyway, the most important document in the redomestication process is the legal plan of conversion. This is a bespoke attorney-prepared instrument. Without it, your filing with the Secretary or Department of State may have no legal effect or unpredictable effects, or very often it may result in the unintentional termination of your company and all of your contracts along with it. LegalZoom and Rocket Lawyer cannot prepare a plan of conversion because they are not attorneys. They are not law firms. They do not owe you fiduciary duties. And the advice from GPT and Gemini and even Claude on this process is still wrong. My law firm handles this process for a flat fee in almost every case. And you can access exact pricing and complete the process on my website right now. There's no need to wait for a sales call. And that's a really important point, right? You don't want to waste time. I personally prepare every document, not an assistant, not a paralegal, not an intern. I do it. I file with both states in the correct sequence. I respond to any inquiries during the process, and I send you weekly written status updates by email until the process is completed. And I back it with a 120% money back guarantee if the Secretary of State fails to approve your redomestication and I am not able to fix it, which to date has never happened, as I truly have a 100% success rate handling redomestications, not a 99.999. No, a true 100% success rate. If you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this process and to schedule time for us to have a conversation about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and it is not legal advice because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these complicated topics, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for us to speak. And I look forward to that opportunity to speak with and perhaps even work with you very soon.